investors now who say, Peter, everything I own's gone down. It's been going down now for a couple of years.
Right.
People keep saying we're at a bottom.
Right.
Should I get out and go into CDs or gold bars and opium or whatever?
Right, right. Well, basically, you look now, you have three choices. I think if you're an investor, you can put your money in a money market fund and get 1.7, 1.5, 1.6, and it's taxed at a 40% rate. Or you can buy a 10-year treasury and get 4.7, and that's taxed at a 40% rate. Or you can have some equities. And I think stocks over the next 10 years will do a lot better than 4.7 or 1.7. So I would have some of my money. Now, it's up to the person to decide how much they want to have in the stock market. For some people, 10% is aggressive. For some people, 50% is the right amount. It's a personal decision. And you can't go by these rules that if you're 25, you should be 100%. And if you're 45, you should be 50%. And if you're 60, you should be 0. And I guess burping a lot. I don't know what the rules are on people at 60, but I hate those rules. I think they're pathetic.
Why are you confident that stocks will be a lot higher in 10 years?
Well, they're not lottery tickets. I mean, when you own a stock, it's a share of a company. And I think companies are going to make a lot more money in 10 years, a lot more money in 20 years, and that's why they go up. That's the only reason. Some companies don't do well. Zero Huxes make a lot less money than they did 30 years ago. It's a lot less. But more companies are earning a lot more money than they were, and that's why stocks go up. Corporate profits have gone up 40-fold since World War II. Stock market's up 40-fold.
It's 25 years since you started running Magellan. You had been director of research for Fidelity. You'd been with them since, I guess, '69. What are the most conspicuous mistakes you've seen investors make?
Well, I think not looking at the balance sheet, and this is a mistake I've made. If you look at a person's balance sheet, you look to see what the assets they own, their houses, if they own a house, if they own a car, what debt they have, and take that away. That's what your net worth is. You should do that with a company. And I've seen investors look at companies that made, let's say, looking at two companies, they're very depressed. They're each at $4 a share. But one company's, and they're each losing a couple $1 million a quarter. One company has $100 million in cash and no debt, and one company has no cash and $100 million in debt. They're about to blow taps on the second company. So and you could do this. If you get through 8th grade math and you get anywhere near 8 and 8 equals 16, you can do this. Look at a company's financial position. It's impossible to go bankrupt if you don't have any debt. I mean, you get the Irving G. Thalberg Lifetime Achievement Award. I think they're bad management. I mean, how